My guest on the show today is the Executive Director and the Chief Investment Officer of India's largest mutual fund, Prashant Jain, HDFC MC. Prashant, what a delight to have you on ET Now. Thank you for joining us. Prashant, if I take the clock back, exactly same time last year, Indian markets were striking distance away from an all-time high. But in last 1 year, Indian markets are down 20%. We have underperformed all other major developed markets and all other emerging markets. So I won't ask you why, but my question is, will we continue to underperform?
I think you need to not focus on 1 year performance. I mean, over 1 year, you will either underperform or outperform, always. If you look at last 10 years, we have outperformed most markets by a very, very large margin. And that is simply because our economy has been growing at one of the fastest rates globally. Any markets over time will track its own growth rates. And time to time, it may outperform or underperform other markets. I think if you look at the P multiples today, if you look at the valuations today, I think valuations are quite reasonable. I think, yes, in India, the growth rates may moderate a bit because we are facing some fiscal challenges and interest rates are high. But we have seen times like this in the past also, that whenever interest rates go up, growth moderates a bit, corrective action is taken, interest rates reduce, and growth again picks up. So I am pretty optimistic on the markets if you take a medium to long-term view.
What is medium term for you?
Medium term, I think in equities is about 2 years, not less than that.
But is the sentiment really negative? Because foreign institutional investors, so far this year, they've not been big sellers. And if I look at Indian retail investors, the SIP culture really has started. So on a monthly basis, they're investing about $500 million.
The sentiment is reasonably negative, I would say. And see, foreigners, I don't think have ever sold big time in India, except 2008. Because India is structurally, I think, emerging as one of the key markets, one of the key economies globally. So if you look at history, in any markets which have delivered significant economic growth, capital will go to that market. I mean, whether it was Japan earlier or Southeast Asia. So because capital always seeks highest returns. So if India is one of the fastest growing economies, it will structurally continue to get a lot of money. So, but money not coming to India itself, to my mind, is pretty negative from my perspective, because India is a fairly attractive, sought-after destination. And yes, SIPs inflows have been growing, but if you look at net inflows, they have been pretty small, and that is what the investor is doing on a net basis. So I would say sentiment has not been very good for last a few quarters.
What are your key macro assumptions for next 12 months? Rates, fiscal deficit?
See, I think the key problem, if you see in India, I think our main problems are internal. I mean, the focus, yes, of course, much more focus is there on Europe or in West, but I think our problems are mostly internal. I think the key issue that we need to address is fiscal deficit. I think if fiscal deficit can be reduced, interest rates will come down, and I think over time the economy will again pick up steam, the capital spending will go up. So I am working on the assumption, I am of the view that next year the fiscal side will be better than this year. And because the government also today realizes clearly that this needs to be controlled, and higher fiscal deficits are not good for anyone over a medium to long term. And if that happens, I think interest rate should also be lower next year. So to my mind, interest rates and fiscal deficit should be better next year than this year.
How are you positioning your portfolios? If I look at your last declared portfolio, you're betting on IT services, you're betting on banks, and you're betting slightly on autos.
See, I think this market is quite different if you compare this market from 2008. In 2008, quality stocks were at a discount. So it was a great market because you could buy great companies at lower than average multiples. This market is different. In this market, the quality stocks are at a very high premium. So even though we are quality investors, we invest in sustainable businesses, we are seeing some merit in going down the quality curve slightly because quality premiums are very, very high. So we have been reducing exposure somewhat, at least in my funds, to consumer and to pharmaceutical stocks. Not because these are bad businesses, but they are very richly valued. And we have been increasing exposure to banks and to some infrastructure companies. And in software, we continue to maintain near index weight exposure.
Why are you bullish on PSU banking stocks?
See, we are bullish not on them not because they are PSU banks or otherwise. We are bullish on them because we believe they have a sustainable business model. The Indians trust these banks, so their people walk across and deposit money in these banks. We are a growing economy. Our savings will grow faster than the economy, and therefore bank deposits should grow at a rate faster than the economic growth. So banking per se in India is a growth business, and we think these banks, by virtue of having a large distribution network, having long years of track record and government ownership, they enjoy the faith of the depositor. So you have a sustainable business. As far as NPAs are concerned, yes, NPAs do rise in times when the economy is moderating, when interest rates are high. But we have seen these cycles even in the past many a times. But I don't think we are taking the view that this economy will stop growing or will grow at 4%. So if economy slows down from 8 to 7% or even to 6.5 or 1 year, 18 months, interest rates over time will come down, and companies will again, some restructuring will be there, some NPAs will be written off, provided for, and over time these will reduce NPAs. So we have seen that cyclically when economy slows, NPAs they do go up, but they do not alter the basic ability of these banks to grow and to make money. And I think the NIMs, the margins in the banking system are reasonably healthy, and they should be able to provide for any increase in NPAs.
For someone who's a very quality conscious stock picker, how come private banks are missing from your portfolios?
No, we have reasonable...
Excepting one or two names.
We have reasonable exposure to private banks. We own quite a few banks. It is just that we think, they are very good quality businesses, but just that they don't leave too much room for returns. That most of that growth and quality is priced in.
Where do you think markets are mispricing growth, where stock prices have been hammered beyond expectations and valuations are looking attractive?
I think, as I said earlier, this markets, the quality is at a very high premium, and so there is some merit, in my opinion, in going slightly down the quality curve if you want to make a good return. So we are seeing good value in banks, and because sentiment has been quite bad for the banks, so some banks are now trading at close to book value levels, and I don't think anyone is saying that book values will not grow in these banks. I think there is value there. I think there is reasonable value in some infrastructure asset owners. We are also seeing some value in cyclicals, even though there is a risk of commodity prices going down, but I think the stock prices are discounting far lower commodity prices than where they are currently.
So you're not negative on commodities?
See, we don't have a very strong view on commodities. We are not experts on commodities, and in my opinion, very few people are able to forecast commodity prices accurately. All I'm saying is that some commodity companies which are very sustainable, which are globally competitive, are available at reasonable discounts to even replacement values. So there is meaningful value there from a longer term perspective. Of course, there is a risk that if commodity prices go down very sharply, then you may not make money on these. But I think in a portfolio context, these still make sense.
You are neutral to slightly positive on IT services. What makes you optimistic there?
See, I think it is one of the few businesses where India is genuinely globally competitive, and this I think people wrongly they overread into the Western how the economies are doing, what impact it has on these businesses. The last 10 years, if you see, IT service exports out of India have grown between 25 to 30% CAGR. IT spending has probably been between 5 to 10%. So 2/3 of the growth has come because Indian companies have gained share, not because the underlying markets themselves have grown. So I think that is because you are globally competitive and you are reducing the cost of delivery, the cost of ownership for your clients. I think this business should continue to do quite well.
But stay with the top 3-4 names, that's where the growth is?
I think, unless a business has a differentiated business model, I think it is better to stick with the large caps. Because, just if you look at a large service company and a smaller company, if service offering is the same, the smaller company will have both a rate or a revenue disadvantage and a cost disadvantage. He or she, that smaller company may have to pay slightly more to retain same quality of talent, and will have to work on a slightly lower rate. So I feel that it's better to stick to the large companies.
I'm going to divide your defensive portfolio into two: pharma and consumption stroke brand owners. Where are you reducing your exposure, pharma or brand owners?
I think both are very high quality businesses, and both are expensive. Both are very sustainable businesses. They should deliver meaningful growth over long periods of time. But both are expensive. I think in both growth rates, most of the growth is priced in. So I have been reducing exposure to both.
Why do you think it's time to reduce exposure to some of these sectors? Why is that these sectors will not expand their P multiples further?
I think that is we have limited amounts of money, and so one tries to optimize the returns in the portfolio. And in my opinion, the risk-adjusted returns are better elsewhere, even though we take a little extra risk compared to these two sectors. But I feel that returns should more than compensate for that, and that's why one has been moderating exposure to these sectors somewhat.
What are your mid-cap bets where you're ready to allocate disproportionate amount of money? Niche businesses, specific companies which have potential to grow in coming quarters, coming years?
See, I would not like to discuss individual names of companies, but I think the sectors broadly where I have discussed, that is where we see value.
Broadly, you don't have a high exposure to autos, and especially two-wheelers. What's the logic there?
So I think two-wheelers is I think that business should mature sometimes in the next few years. This is my opinion. In the current year, the country we should be selling about 1.3 crore two-wheelers. If this industry grows at 15% CAGR, in 5 years we should be selling between 2.5 to 3 crore two-wheelers. The population of two-wheelers currently, which is 6 to 7 crores, should grow to 15 to 20 crores in 5 years' time. And we are a country of 20-22 crore households. I think that will be a very high level of penetration for this sector. So I think sometimes over the next few years, the growth rates in this sector have to moderate very sharply. And I don't think the current prices are discounting that.
How are you approaching government-dominated businesses which are dependent on government spending, government order book, names like BHEL, L&T?
I think in capital spending there is definitely a slowdown, and because whenever high interest rates are there, you will find slowdown in four-wheelers and in capital spending. So I don't see great value in this. We are underweight on these businesses, but I don't think it has got so much to do with government spending. It has got more to do with the higher interest rates and maybe some uncertainty in some areas which are delaying new projects.
So as of now, you want to stay out or stay away from government-dominated sectors?
See, government-dominated sectors, again, if as a result of higher interest rates, capital spending is slowing down, I think that is more important. But there aren't too many government-dominated sectors. Today, you can say PSU banks are government-dominated, but otherwise, other than banking and oil, I don't think the PSUs are really dominating in any other sectors.
In the past, you've had a fair bit of exposure to stocks like ONGC, HPCL, BPCL. What are your thoughts on A, oil marketing companies, B, in general when it comes to the oil sector?
Yeah, I think these businesses have great entry. They have great advantages. They have huge assets, and they are sharply undervalued if you compare them to their replacement costs or the resource base. But given the burden of subsidy on these companies, their profitability is quite low, and the stock prices are reflecting that. We have been of the thought that at some point of time the subsidy burden will either reduce or will not be there. So we have investments in this sector, but so far those hopes have not come true. But I think sometimes over the next few years, I still maintain that view that whenever oil prices stabilize for an extended period of time, 2-3 years, I think the subsidy burden for the whole system will have to come down, and therefore these companies should do well over time.
Mr. Jain, between 2003 to 2007, Indian markets, they went up by 4 times. And that time we had a near perfect scenario. Credit growth rate was high, inflation was low, and India was growing at 9% plus. Do you think that secular trend what Indian markets saw between 2003 to 2007, that is over for us?
I don't think so. I mean, you can look at last 50 years and you can see that the growth rates in India have been increasing every 10 years. So I think that trend is here to stay, and in the next decade our growth rate should be higher than in the current decade. The problems what we are facing mostly to my mind with regard to higher fiscal deficits and higher interest rates are transient. They can be corrected and the solution lies within us. I think they will be corrected and then we should start growing faster once again.
There's a lot of chatter that government is not acting enough, there's no policy reform, on ground things are not moving. How do you want to respond to that?
I think we are a democracy and we are a coalition democracy. So change is always difficult in such an environment. And I have seen in my experience that every crisis, every pressure leads to change for the better in the country. But it does not happen over 3 months. But over time I think things do get resolved. So I am not saying that one is happy or satisfied with the pace of change, but one has to be realistic. And I think that the current problems what we are facing will lead to change for the better.